The title of this talk is Premiums Explain How the Wealthy Move Money, They Don't Spend It, right? And how to turn a payment, which you think is like this premium payment, into a weapon for building your wealth and building your freedom, right? Okay, so what if I told you that the wealthy don't pay premiums? They move money into a better system. And also, once you start buying cash flowing assets and you flow revenue or cash flow from those cash flowing assets, your tenants, your customers, they're paying the premiums, not you. So most people think premiums are a cost, but the wealthy know that it's just a strategy. Because most people think debt is bad, but wealthy people know that good debt is good and that you need good debt to use somebody else's money. Told this story before, but I was like 35 and I was working with this guy that we were going to buy a business and we were buying it from a really big business. I'm thinking, man, okay, I got to come up with this amount of money. I got to come up with this. And he looked at me and he said, Jim, we're not going to use our own money. Nobody with money uses their own money for these things. We're going to use somebody else's money. And it was just hit me like, yeah, duh. Just remember when you're paying these premiums, so we want to use other people's money. And when you're not paying to an insurance company, you're putting the money through a system. So you're building a better system. You have a strategy and you're putting money through a system that you control. And we're going to break it down on the truth about how premiums really work, why they're misunderstood, and how to get them to get the premiums up as big as you can, print cash. Okay, sound good? All right. So the engine, when we think of like your wealth engine, how you're going to, and we've talked a lot in the last few weeks about being wealthy is to be of service. It's to be poor or in poverty or in scarcity in our thinking is actually selfish, okay? Because if I gave you $1 billion today, would your church or synagogue or your favorite charity get more this week or less than they did last week? And I hope it's more. I hope the answer is more. So I hope it's a lot more, okay? So with this whole engine, the system is you have this life insurance policy. You act like your own banker, IBC. You become your own banker. You perform the banking function in your life. Somebody's going to be the banker in your life. It might as well be you because that's where all the money's made. And then you go buy cash flowing assets. 1, 2, 3. Dancing is simple too. 1, 2, 3, 1, 2, 3, whatever, right? But it's not easy. Trust me. If you ever saw me dance, you'd know it's not easy for me anyway. But you're not buying a life insurance policy and letting it just sit there. You're building your own private bank, meaning somebody else doesn't make the decisions, right? A community bank, the bank board, the bank management, they make the decisions. So let's just break this down into plain English. Premiums equal deposits. Now, think about this in banking. The banks don't use their own money. They need deposits. You go down, you deposit money in the bank. That's a liability for the bank until they do what? They loan it out. So what's the loan? The loan's the asset. So do not be afraid of the loan. So you deposit it into contracts with guarantees, not IUL, not payments that disappear. You want to continue to flow money through your bank. When would your bank be full if you owned a brick and mortar bank? It would never be full. What would you do if there was too many people and too many people coming in? You'd build another one and another one and another one and then accommodate everybody. Let them all bring their money. Doesn't that make sense? The base premium, back to Michael's point, builds the guaranteed portion. Remember, there's guaranteed growth. So it's important and it builds dividends. The paid up additions, they're the rocket fuel. So the way that I always used to explain it is the paid up additions gets the car off the line fast, right? It's like your turbocharger, supercharger, whatever. I'm going to show that I don't know anything about cars. And other than I like nice cars, it's going to get you off the line fast. To get you to top speed, though, you need that horsepower. The base premium is the horsepower. The turbocharger is to get the wheels spinning or get the wheels like cranking to get 0 to 60 in 2 seconds, right? Now, here's the thing. Cash value grows tax advantage and can be accessible in a couple of days. Can it be faster than that? Absolutely, it can be faster than that. So let's just look at this IBC framework, okay? This is how the machine really works. You move money into your policy, grows safely, and it's liquid. Sounds good so far. You borrow against it while your money still earns uninterrupted compound interest. Now, back in the day, I used to do this example of a penny doubling every day. And if a penny doubles every day, so it goes from 1 penny to 2 pennies to 4 pennies to 8 pennies, at day 22 or day 21, I'm sorry, you have about 20 some $1,000. But you got to go buy a new car. Your car, you got to trade it in and get a new one. And you need $22,000, everything that you have in the balance, right? And that's on day 21. What happens to the compounding when you take that money out from day 22 to day 31? It starts over. So you're back to a penny. And at the end, you end up with like $30,000 or $12,000 or something. I wish I had the numbers in front of me, but it's nothing. If you don't interrupt the compounding and you borrowed against it to go buy the car and you let it compound, you'd have over $1 million at day 31. Now, can I compound your money double every day? No. But this is like an extreme example so that we can blow it up as big as possible, just like we would a photograph, so that we can see the tiniest detail. That's all I want to do there, is just show you that uninterrupted compounding. I have to have that. So this is, again, the machine. You move the money into your policy. It grows safely, liquid, guaranteed. You borrow against it while your money is growing uninterrupted. Then you buy assets, business, real estate, cash flow plays. What can generate cash flow for me? And then you recycle the cash flow back and repay the loan or reload the system. Guess you get to do that. You get to decide. Am I paying back the loan? And the money will start to come to you faster than it'll hold the policy, because guess what? Then what happens? You have to get another bank. You got to keep on increasing the capacity in your bank, which is what every bank in the world is doing, right? They want more and more and more deposits. So you're not paying premiums, you're funding your own wealth engine. Okay, so just think of it that way. All right, so here's some misunderstandings. And this is where, because of these misunderstandings, is where some of this 90-10 and IUL and all this comes in. Misunderstanding number one, it takes forever to build cash value. That's just not true. You have between 60 and 70% of the cash value year one. Now, if you do a 90-10, you're going to be in the 80, 85, maybe a little bit better, depending on how young you are, range. But where's that shrinkage? I mean, it's 90-10. Shouldn't I have 90% cash value? I don't know, that little thing called insurance cost, right? And so that drags it down, not just for that first year, for the second year, for the third year. And a lot of these guys show you putting that PUA in for 10 years. So you got to wait 17 years to take that off. If you're 50 and you're paying premiums at 67 to avoid a meth, trust me, it's going to drag the cash value down. And you're not going to leverage like 60-40 or 70-30 or 65-35, somewhere in that range. Nelson said the best policy, or for me, 50-50, because I'm 60. My policy won't go 60-40. It's 50-50. And I have no problem with it. I'd buy all that they will give me in a second. All right, so you can do that year one. Every year after that, it gets better and better and better and better. Around year 4, you're going to put $1 in, you're going to have more than $1 to use. At that point, you win. You're leveraging. All right, so misunderstanding number 2, I'm just giving money to an insurance company. No, I would never tell you to put hundreds of thousands of dollars in an insurance company, an insurance contract, and let it sit there. That's what IUL people do. That's what mutual fund people do. We don't do that. This is put your money in motion. That money is now part of a contractually guaranteed tax-favored asset. Don't we all want assets? Asset. Cash flowing if done right. Okay, here's another thing that's a misunderstanding. Premiums are inflexible, so that's why we want IUL. The truth is that premiums can be customized. I mean, base plus PUA equals total control. I can adjust the PUA. The PUA is not required, right? The base premium is required. I have to pay the base premium. Trust me, you're going to get to the point where you want to put all that money in there and more. That's not the problem. Nobody's ever said to me, I wish I would have done less. That does the system. Nobody. So it's total control. It's flexible. Banks, billionaires, businesses all do this. Fortune 500 businesses, they all do it. But they don't call it life insurance. They call it tier 1 capital. And a bank is only allowed to have 25% of their tier 1 assets, tier 1 capital, in life insurance. Why would the government limit how much money they could put in life insurance if it wasn't a place they wanted to put money? All right, so everybody always says, give me an example, right? And there's people on this call right now that have great examples of this, by the way. And if there was a way for me to let somebody talk, I would and let them share. I'm looking at our time. I think that we have time. Hopefully we have a few questions. I haven't looked at the chat here for a second, but here's a couple of examples. I took $150,000 premium and I borrowed like 100 grand the first year. And I acquired a business. And once we got in there and did a quality earnings report and we did some analysis and we cleaned some stuff up and we got one more customer, the thing started cash flowing 15 grand a month. Okay, that's not net. I got to pay. I mean, without tax strategies, that's income, right? With tax strategies, hopefully it's not. Back then, it was probably 90% of it wasn't. But that's $180,000 a year. Would you want to give? I mean, and by the way, I borrowed, it was 100 grand plus the seller financing of 80%. It was 80, not 90. It might have been 90, but anyway, it was seller financing. And then the thing did 15,000 a month with cleaning up some stuff and one more customer. Do that 10 times. Do that 10 times, and I guarantee you that most of you on this call wouldn't spend all that money in a year. And if you're not spending all your money, where does it go? The things that you care about, whether it's your family, your church, the kingdom, the synagogues, charity, wherever it is. Okay, so that's an example of what I like. Again, $150,000 premium. And what if I did that with $1 million premium, right? I mean, you could see where the vision in your head and the wheels should start to turn. But we had a client that moved $1,000 a year into his policies. And then he was borrowing out $60,000 each year to go and acquire short-term rentals that was like a 20% down payment or 10% down. I think it was 20% down payment. These are like little condos, right? And he has 6 doors now. I think he's been doing it 2 years, 3 years. I can't remember. And $400,000 of accessible cash value. I just looked it up. That's why I'm not saying his name. And I just looked it up, and it's like $400,000 of, now, by the way, his loans against that, right? He's got loans out there, but $400,000 of cash value inside the policy, growing tax-free every day, guaranteed, uninterrupted, and $1,000 almost of loans out there for almost over $3 million of real estate, because it's lever. I mean, he's doing seller finance. I think there is a bank one that he said that there was a local bank he used. He's in the Midwest, and these things are cash flowing, right? So when you understand how premiums actually work, they stop becoming a cost and they start becoming the most powerful move you can make. And again, just remember, the wealthy, they don't pay premiums. They move money into a better system. And once you understand what I just showed you, and you can do that, the premiums are the greatest wealth accumulation tool ever created. Nelson would say that. You'll see it differently. And remember, it's a properly structured whole life insurance policy, preferably not with a term rider. Okay, so that's about 60-40. And yep, the first year, there's some cash drag. The second year, not much at all. And by the fourth year, every dollar you put in, you have more than that dollar to borrow out. It's, if somebody says to you, like in your family, man, you're paying big premiums, just say, no, I'm positioning capital. They'll have no idea what that means. You know, I'm locking in growth, liquidity, tax advantages, and more importantly, I'm keeping the control of my system and control of my money. And you know what they're going to say? How are you doing that? That's exactly what they're going to say. Or they're just going to, it went right over their head and they're going to be like, well, I just bought Apple when it was this and now it's this. Okay, play that game, because, I'm not saying if Apple went down 50% tomorrow, I'm not saying don't go buy it. Okay. But, it's scary a little bit when you do that, right? All right, let's see what questions and everything we have. Yeah, Glenn, perfect. The opposite of long term. Yeah, the agents, they want this short. Again, think about this for a second. If I'm getting 6% on a PUA, and I'm going to do a 90-10 on a $100,000 premium, so I'm going to get 6% of 90 grand going in for 10 years, right? Yes, I'm only getting base commission on 10%, but it's going long. That commission's going for a long time. They're building an annuity. Those agents are greedy. They want an annuity that pays them every year. That's why everybody's trying to get assets under management, charging a point, all this stuff, because then it's easy. Everybody wants comfort in their lives. They don't want freedom. They want comfort, and comfort kills. We've talked about that. The real thing today is, and it just kind of hit me, premiums are not an expense. And think long term. Just think long term. It won't be that long. Glenn is a perfect example of that. It didn't take long, but he has long-term thinking. But what he's created in just a few years is what everybody wants. And now it's just how many times can you do it? Well, he's not going to stop. I mean, he might stop someday and just go, okay, that's enough. But what happens when you have your own banking system is opportunities find cash. So there's going to be other opportunities that are going to come up for Glenn, and he's going to have cash flow coming in and be like, okay, I need to reinvest some of this cash flow. And it's so much fun. When would you pay off your loans? Glenn asked, compared to paying off PUA. Again, it's funny because you're probably a few years away from, the answer will be yes. You'll be doing both of those things. Is probably in somewhere around year 4 or 5. If you didn't expand, you should, the PUA becomes, you start to focus on letting the cash flow pay the loan off. So I would say 4 or 5 years. But what's going to happen is, my example of using real estate, and if you haven't seen this is in the course on the community.createtailwind.com. On there, I showed just taking $100,000 and then using it at 80-20 loan to value, buying real estate. So I hope this was enlightening. I hope it helps. I hope it's motivating. I hope everybody's out there ready to build their bank to the biggest thing that you can. And thank you all for being here. As you can tell, I have a big project going on. I'm going to do a new background. It's going to be cool. It's going to be charcoal. It's going to have some character to it. So I'll see everybody next week. Speed, thank you for being here.